Thank you for listening to the Real Estate Voice podcast. This is Vernon R. E. Jones, managing broker, owner of Jones Homes, and for over 30 years, we have serviced the 7-county Denver metro area. Federal Reserve Board decides to pause rate hikes. Several economic indicators are showing improvement, but the Fed warns that 2 more rate increases are likely this year. As if we need that. That has some economists concerned, and many other business people as well. Ending a cycle of 10 consecutive rate hikes, the Federal Reserve Board voted this week to hold off on another increase to its key short-term interest rate. The news fueled hopes that borrowing costs for home buyers could cool in the coming weeks, but only if the Fed continues to pause rate hikes. Mortgage rates are not directly tied to the Fed's benchmark rate, but are often influenced by it. The Federal Reserve Board's decision at its latest meeting came on the heels of an improved inflation rate, which was at a 4% annual rate in May. That's the lowest level it's been in 2 years, but it's far from the Fed's 2% desired target. It also marks the first month in 2 years that wage growth outpaced consumer price inflation. In essence, it improved, albeit minutely, the average standard of living. However, the Fed on Wednesday signaled that 2 more increases to its benchmark rate are likely this year as it continues to manage the inflation rate. Further rate hikes are unwarranted in the real estate industry and other sectors of the real estate, especially the commercial sector, but that's a totally different other podcast. But the Fed may need to start lowering its rate soon. In regard to the Fed's monetary policy, sometimes they forget that monetary policy lag time exists between decision and inflation. Rate hikes from earlier months have yet to exert their force at a time when inflation has already decelerated to 4%. As you remember, it was at 7-8% not too long ago. There is no need to consider raising interest rates. In fact, considering the balance sheet difficulties faced by community banks and the weakness, as I said, in the commercial real estate sector, the Federal Reserve should look at cutting interest rates before the end of the year. The Federal Reserve Board should look forward, not backward. How mortgage rates could respond. Mortgage rates are more closely tied to the 10-year Treasury bond, which responded this week to better inflation news with a rate decline. That normally means the 30-year mortgage rate is around 5.7%. Of course, we know the mortgage rates have been nearly 7%. But the potential for a decline is real as we progress through the year. Again, let me say that again. Normally, based on this level of inflation, mortgage rates are usually around 5.5 to 5.7%. And we're obviously at 1 point plus above that. Freddie Mac reported that the 30-year fixed-rate mortgage averaged 6.71% last week, up from 5.23% a year earlier, and an even further spread from the 3% averages in early 2022. Let me be clear again. The interest rate hike from 3%, which was basically what rates were early 2022, to what they are now, is the largest increase over that time span in 40 years. The Fed's latest decision to hold off on a rate increase in June will ensure that mortgage rates are likely to keep moving sideways for the next couple of months. Again, probably going to be moving sideways, laterally. In other words, they're going to be hovering around 6.5%, 7%. The higher rates have added considerably to home buyer costs. Fed's latest decision to hold off on a rate hike in June will ensure that mortgage rates are likely to keep moving that for the next couple of months. While the Fed short-term rate does not directly impact long-term mortgage rates, as I've said before, higher borrowing costs have been trickling through the financial system. The 30-year fixed mortgage rate hovers and continues to hover between 6 and 7% since mid-November of last year, cresting the upper limit several times over the past few weeks. The spread between the 10-year treasury bond and the 30-year fixed mortgage rate remains about 300 basis points. The economy remains on solid footing, employment continues rising, and consumer spending has been resilient, even with higher borrowing costs. The big question for the central bank centers on consumers' ability to manage high interest rates, considering record high debt levels, which I spoke about in my podcast in May, that the debt that families are accruing because of the inflationary pressure is considerable. Thank you for listening to the Real Estate Voice podcast. This is Vernon Irie Jones. Any questions, feel free to call us directly at 303-359-8218. And as always, please be safe.